The yield curve has been a topic of conversation for investors recently, particularly as the front end has inverted as the market begins to discount Fed rate cuts. The Fed itself reckons that the 3-month to 10-year point is the most signalling part of the yield curve. This is the point which has preceded every one of the last 6 recessions. But this point is still not perfect. In 1998, there was an inversion in the 3-month, 10-year point, and a recession didn't immediately follow, although there was one within the next 3 years. At the time, there was the Asian crisis, which led to the Russian default and LTCM, and the Fed reacted quite aggressively to the curve inversion, which helped to avoid any dramatic deterioration. We looked at the market effects of the 3-month, 10-year inversion to try to separate the signal of the inversion from the noise. Although the yield curve does invert before recessions, it doesn't necessarily mean it causes recessions. And what we found was that there's a lot of noise in this signal. First of all, on an asset class basis, the inversion doesn't have a tremendous signaling power for the S&P, for the dollar, or for 10-year yields. Although it has to be said that over the last 50 years, the S&P has tended to rise by about 4% every 6 months. In the 6 months following yield curve inversions, the S&P tends to do nothing. So there is some sign that the inversion does precede periods of lower than average returns. But it does look like there is more signal than noise when you look at equity sectors in the US. We analysed the last 3 inversions and recessions since the late 80s, and defensive sectors tended to outperform growth sectors. So for example, energy, healthcare, utilities, and consumer staples tended to outperform consumer discretionary, banks, and materials. So we reckon, although the economic signal might be a bit noisy, the timing of the recession following inversion might be a bit uncertain, but the market signal is telling us something important. The S&P stops rallying as well as it has done in the past, and there is a rotation in leaders from the growth sectors to the safety sectors.